I noticed that in my own portfolio, physical silver, which I'd bought on an average of $20 an ounce, had exceeded handily my target. I bought the stuff at 20 because it was hated. And you and I talked about this in an interview 4 or 5 years ago, the fact that silver was absolutely hated and a coiled spring. And I said to you that I thought that silver could handily take out its old nominal high at $50. Well, I was wrong. It took out 75 instead. The fact is that I bought the silver because I thought it was oversold and hated, and I thought it would recover. When my investment objectives were reached, I sold my silver, my physical silver, at least 80% of it. Now, there's a lot of people who are in place in silver, and for them, well, they have nothing to sell. What I have decided, for me personally, is that there's more torque left in the silver stocks, and I have a durable competitive advantage. For me, gold is a savings asset, and I haven't sold any of my gold. I've added to it. Silver is a speculative asset, and I'm a good speculator. So I decided to redeploy my physical silver assets into silver equities and oil and gas, which is to say I've used some of the outside strength that we've seen in the last 3 months to shift my risk focus down rather than up. Now, I need to say to people that most people require, even if they understand a narrative, price action to justify the narrative. And it's wild to see a circumstance where more people want to buy silver at 80 than did at 20. When the price moves from 20 to 80, understand that it is precisely 80% less attractive. That's just the way it works. The easy money is made when you buy based on hate. If there's a popularly held public pretense that's wrong and you bet against it, that's the easiest money financially you can make and the toughest money psychologically that you can make. What that's meant for me personally was that in October, I sold 25% of my junior stock portfolio, my junior mining portfolio, because I felt that the sector was ahead of itself. I felt, too, that by selling off 25% of my upside, I could eliminate my downside, which seemed like a very good trade. It is a truism that you haven't made the money until you've taken the money. What's probably instructive is what I did with the proceeds. I took half the proceeds and I bought physical gold and a package of 3 senior gold stocks, Franco-Nevada, Wheaton, and Agnico Eagle, which is to say I didn't exit the sector. I just de-risked. I went to beta. Normally in a bull market, you would go from beta to alpha. But as I say, this market short-circuited beta and went straight to alpha. And so I de-risked.
Rick Rule sold 80% of his physical silver at $75 to $80, bought at $20, locking in a triple. He rotated into silver mining stocks and oil and gas, where he sees a competitive edge. Rule also sold 25% of his junior miners in October, taking profits. His move exemplifies his core principle: buy hate, sell favor. While long-term bullish, he warned silver at $80 is mathematically 80% less attractive than at $20, teaching disciplined profit-taking over FOMO.
I believe, Dunnigan, as you and I have discussed many times, that gold and silver continue higher, but probably at a less voracious pace. I believe it not because the price has gone up. That makes it less attractive. I believe it because I believe over 10 years the purchasing power of the U.S. dollar declines by 75%, which is, sadly, very good for the nominal price of gold and silver. So I suspect we'll continue to have good years. If you try to measure the years that we have in the future, by 2025, you will, almost by definition, be disappointed. I believe that inflation, which I define as the deterioration of the purchasing power of the U.S. dollar, is proceeding along at 8 or 9% compounded. Look at the price of gasoline over the last 5 years. Look at property tax. Look at health insurance. Look at groceries. Look at rents. Look at mortgages, which have doubled. Mortgage insurance, which has doubled. And explain to me how the deterioration of the U.S. dollar, the purchasing power of the U.S. dollar, has been at 2.5% compounded. Now, It's interesting that when I talk about the deterioration of the U.S. dollar proceeding at sort of 8% compounded, it's interesting to note that if you look at the gold price in 2000, the year 2000, 25 years ago, and 2025, that the gold price increased by 9% compounded. I would suggest that the price of gold, the nominal price of gold, the U.S. dollar price of gold, is over time a much better gauge of the deterioration of purchasing power than the U.S. dollar, than the CPI. We talked before that the period 2000 to say 2023, mid-2023, was a period of time when the stage was set for gold, but gold didn't respond. What gold has done in the last 2.5 years is made up for lost time. A much better measure of the performance of gold relative to the purchasing power of the U.S. dollar is over a long period of time, which is to say the year 2000 to 2025, where I would suggest the real rate of deterioration of the U.S. dollar was 5.5 or 6% compounded, and the rate of increase in the nominal quote in gold was 9% compounded. Disciplined selling is a critical component. The idea is that you are supposed to buy low and sell high. That means that you're supposed to buy hate, which is very tough to do, and sell favor, which is equally tough to do. In my days in the brokerage business, I received more complaints about foregone profits than I did absolute losses. And I want to teach people the fact that in investing, there are at least two primary sins. One is the sin of omission. The other is the sin of commission. What you learn in natural resource businesses or any capital-intensive cyclical business, it's really tough to do. And it takes 10 years at least. But what you learn to do is love-hate. You learn to begin to sell stuff where you have psychological verification in spades and buy stuff where you have a lot of doubt and the market hates you for doing it. And it's tough to do. It's really, really, really tough to do. But once you've learned how to do it, I've been doing it for about 35 years now. It gets easy because you compare your personal balance sheet with others about you who are less disciplined, and you see that it works. There are very few commodity sectors that are hated, even now with the problems in Venezuela and Iran. Even my favorite pariah, oil and gas, is starting to catch a bid. So I've gotten out of the way. The fact that the oil stocks and the oil service stocks are up 15% makes them 15% less attractive to me. And my suspicion is that their favor has a lot to do with people trading the news, which is almost always a losing trade. There are places that are hated. Congo, for some reason, is hated. Russia is hated. Because I have a banking organization, I personally can't invest in Russia, but other people who are less constrained can. I would suggest that sulfide nickel, while not hated, is still underpriced. So I would look at that. Canadian oil and gas is up across the board, but it sells at a discount to oil and gas in other parts of the world. I can't find a stock, although I'm sure they're out there, that is roundly hated and is selling at a substantial discount to what it's worth. I suspect that one such stock might be Rosneft, another might be Gazprom, a third might be Nornickel, and Lukoil, which is to say the Russian super major mining and oil and gas companies. I would argue that the rate of inflation, which, by the way, I define as the rate of the deterioration of the purchasing power of the U.S. dollar, while not at hyperinflation levels, is at levels that are probably triple the levels that are indicated to you by the CPI. And let me explain. The CPI is a construct rather than a measurement, which is to say it's an index that is assembled by the indexers. Among other things, the CPI doesn't include food or fuel when it's inconvenient. If you drive or enjoy lunch, the index is of limited utility to you. I would suggest that the Bureau of Labor Statistics, the people who populate the Bureau of Labor Statistics, don't shop, Dunnigan, where you or I or your listeners shop. A simple thought experiment where you look at the price of a basket of goods and services that you consumed in 2020, and you look at the price of that same basket of goods and services today, will tell you that the 2.5 or 2.6% estimate of the CPI is fiction at best. There are other people who probably have less speculative alternatives than I. And for them, they probably shouldn't sell their silver. I believe that the silver price is going to go up from here. Make no mistake. I also believe that I have a competitive advantage in silver stocks, and that the silver stocks, the best of them, will exhibit more torque for silver. Because I've spent almost 60 years learning how to speculate in silver stocks, it makes perfect sense that I would sell my silver and buy silver stocks. For somebody who doesn't have the same experience or the access to information in silver stocks that I do, it probably doesn't make any sense. So the fact that a so-called expert, Rick Rule, did something, first of all, you need to understand what he did, as opposed to what the AI headlines or the X headlines suggest he did. And the second thing is that you need to personalize it. I can give you broad guidelines. I can tell you this. In cyclical capital-intensive businesses, the easiest money made is to buy hate. The easiest money made is on the Dunnigan-Geiser show when I say the uranium stocks are so stupidly oversold that they're free. What many people do is they look at the stock charts and they say, well, the chart's going down. Why would I buy something that's getting cheaper? Or when I say silver's way, way, way oversold. All those guys who got massacred in the silver squeeze hate it. And I love hate. A truism is that you need to learn to love hate. You just need to learn to love hate. The easiest money that's made is money that's made on hate. That one is a truism. The rest of it's all conditional. Why I bought it, what could go right, what price movement I think I can expect if things go right, what time frame it'll take, what could go wrong, and what would make me sell it. I review that template at least quarterly, or every time an individual investment has news, to consider that news in the context of my reasons for buying that asset. With regards to silver, as I said, I bought it because at $20, I believed it could go to $50. I believe it would do so in 2 years, which meant that I would enjoy a 2-year double. I was wrong. I enjoyed a 2-year triple or better. But the point is that the position that silver inhabited in my portfolio meant that the reason that I bought silver had occurred and its utility had occurred. And then I had to think, is that portion of my portfolio, that speculative portion of my portfolio, best reflected in physical silver or best reflected in a different asset class? So teaching people the discipline of putting their buy decision down in writing and establishing a template and a discipline around selling is an important part of keeping the money that you make in a bull market. Most people, Dunnigan, in this bull market, sadly, will miss it. They'll come on late, they'll ride it up through the blow-off phase, and they'll hold it on the way down. And that's a tragedy. I did that my first bull market. I went from being an extremely wealthy young guy in the middle of that bull market to having a net worth below zero after the end of it. And that's not going to happen to me again. Then, after I've taught people how to construct these templates, I'm going to talk to people about the techniques and the methodologies around selling.